And meanwhile, U.S. home sales falling again for the 6th month in a row for the month of July. That was 6% down from the month before, according to the National Association of Realtors. Higher mortgage rates have pushed buyers to the sidelines, and the housing supply, though, still remains very tight. Sales have dropped about 20% from July to last year, and it is the latest sign that the housing market might be cooling down. The median home price rose 11% in July to more than $400,000, but that's still lower than June's record. Thomas Hayes joins me now for a closer look at the U.S. housing market, founder, chairman, and managing member of Great Hill Capital. Good to see you, sir. We talked about this last time, in fact, that was one of the key things that we were looking at was the housing market, that it was still, while softening, still robust. How do we describe it now after this latest report?
Yeah, well, I think this is the lagged effect of the tightening cycle, Phil, which started in March by the Fed. You know, building permits were down 1.3%, housing starts down 9.6%, and as you said, existing home sales down 5.9%. When you double the cost of capital in such a short period of time, that has a tendency to happen with the 30-year fixed over 5%. However, I think this is setting us up for an opportunity, Phil, and the reason that I say that is we have a structural underbuild of about 3.8 million units, and we've got 72 million millennials. And when you look at some of the home builders that cater to the starter homes, like D.R. Horton, like Pulte Homes, like KB Homes, D.R. Horton's trading about half its historic multiple, trading at 5.4 times next year's earnings. Pulte Home trading at 4.3 times next year's earnings, and KB Home trading at 3.35 times next year's earnings, compared to the market trading at about 18.5 times next year's earnings. You start to look at these and you say, yeah, you'll get some cancellations, but cancellations have only ticked up modestly relative to history, and I think that really sets up an opportunity for the calm hand to wait for maybe the next pullback on these home builders and start to think long-term, because that demand is not going away.
But let's be honest, if I was having a beer with you and we were talking about the housing market off the record, we would probably talk each other into saying, why don't we wait a few months or wait till things settle down? In fact, Fitch had a report just out saying that they think that the housing market could dip as much as 15%, which even to me as a big market watcher, house prices are up 60, 70, 80% from just 2-3 years ago. So giving back 10 or 15% doesn't seem like that big of a drop, does it?
I agree 100%. I do think we could see a further softening in prices, but I think in terms of units produced by the home builders, if we're looking at it as an investment standpoint, if we're looking at it as a real estate investor saying, should we buy houses now, existing houses, et cetera, or should we wait for the market to cool a little bit? I don't have a great answer for that. That's not my knitting. What I look at is overshoots in terms of publicly traded securities. And if you look at the S&P 500 down about 11% year to date, the whole home builder index is down double that. To give you an idea, new entry-level housing supply averaged about 150,000 units per year from 2000 to 2010. In the 2010s, it dropped to 65,000 a year, and in 2020, it dropped to 55,000. So there is a structural undersupply, and we have more demand coming online with 72 million millennials, average age 31, 32, and the average starter home purchase age now is all the way up to 33. So this is going to be structural demand for the next 5 years. And I do think we're closer to the end of the tightening cycle than we are to the beginning. So as housing prices cool a little bit and rates stabilize a little bit, historically speaking, you know, in the 70s, rates were 12%. In the 80s, they were 8 or 9%. They're still historically low. We just need to get that footprint, the size of the new supply, to a more normalized level. They can't afford these 3,000 and 4,000 square foot houses that were built for the baby boomers who are aging in place, but they will be able to afford the $300,000 and $350,000 starting homes, even at a 5 or 5.5% 30-year fixed.
In New York City, I think it doesn't like 500 square feet go for a couple $1 million now, probably in New York City. I saw a stat that says that the prices have surpassed where they were prior to the pandemic, which makes New York City unbelievably expensive. I saw one stat that said that the United States is short nearly 3.5 to 4 million units. Now, part of it is that multifamily or apartments that we're talking about. And with the cost of construction up, how are they going to meet this demand? Because if I'm a developer, I'm thinking to myself, I don't want to do this, because if I'm worried about prices dropping and I'm going to be building and paying these high prices, there has to be some compromise there.
Yeah, I think what you're going to see is smaller footprint. I think that's the name of the game. You want to think of Levittown post-World War II, when they built smaller houses that met the demand for that demographic, the baby boom. And I think we're in a similar situation. We have too much supply of big and expensive houses, too little supply of smaller houses. And I think you're going to find more land out in the exurbs. More people can remote work at least a few days a week. That'll bring down costs in terms of land costs. You've seen lumber collapse in recent months, so that's a positive sign. Many of the commodities and materials are lowering. The one thing that is going to be sticky on the building front is going to be the labor costs. So that might lead to a bit of margin pressure, which is why you're seeing these stocks trade at half of their historic multiples, although the fundamentals are much better. But if you do put it in perspective, many of these are trading in terms of value. In terms of price, they're trading at or maybe slightly above 2006 levels, but the fundamentals have gotten so much better over the last 16, 17 years. So it's not go rush out and buy today, but if we get any further weakness in the fall, you may want to take a look at some of these for the longer term, because that demand is not going away irrespective of the cost of capital.
And I suppose jobs has a lot to do with this, because if you don't have a job, you obviously can't buy a house. So we'll be watching that number very closely as well. Thomas Hayes, good to see you, my friend. Founder, chairman, managing member of Great Hill Capital. Always good insights from him. Next up.